And now for something completely different. Each year we put a spotlight on what we believe to be hot sectors, and we'll open our sector discussion today with the focus on energy and tongue in cheek. The title suggests that there's trouble in the energy sector and that we may be running out of steam. But I'll be honest with you, when we committed the energy sector to this agenda, we fully expected that alternative energy source providers would be a part of the conversation, but that was when oil was still trading above $75 a barrel. That's changed dramatically, and I think we would be remiss here today if we didn't focus our discussion on the current oil price effect, both on valuation and the liquidity of oil and gas production and service companies. And so to lead off this discussion, I'd like to invite Pavle Savic from S&P Capital IQ to come up and share some of his wisdom and the perspective that is afforded to many in the industry through their research. Pavle.
Thank you very much. Good morning. That's correct. So we're part of McGraw-Hill Financial, and with that we have access to many information. We have Platts, of course, S&P Capital IQ, and S&P Ratings. So I thought it would be appropriate just to start off by looking at an overview of the energy sector and in terms of what's happening and where we're at. And really, it's three questions that I want to start off with. And where will prices go? Will they recoil to their highs? And have we reached the bottom? And we did a survey back in September of last year when we asked leading energy, stalagmites, if you like, in the industry. We had a conference in Texas, and we asked them, where will the energy prices be at the start of trading in January 2015? And none of them predicted it was going to be so low, and the majority of them said, more than 80%, that it wasn't going to go below 80. Now, of course, today we're at 53, and things have changed dramatically. Now, why is that? I think a lot to do with supply and demand, plain and simple. And when you look at the data, it's quite evident. So if you look at the increase in production that's been happening in the US, so back in the end of 2012, we were around 7 billion barrels per day. At the end of last year, we're actually at 9.2 billion barrels per day. So a significant increase. Obviously, imports have actually stopped as well, or declined for the US. And what's happened in terms of the actual demand, well, we're pretty much hovering around about 15 billion barrels per day. And that's been the same from end of 2012, now up until recently. So supply and demand, and as the supply has gone up, the demand has stayed and prices have tumbled to kind of all-time lows. Now let's look at the IPOs. It's surprising because the IPOs are actually a record high this year. 31 IPOs, global energy sector, 13 billion in IPOs, so it's completely different. But then when we look at the repricing of credit risk within the energy sector, CDS spreads have blown out. And the CDS markets, when you look at these spreads, they've widened significantly. And also, the repricing of this is very much down to the actual decrease in crude oil prices. So when you start looking at the probabilities of default and distressed debt, we actually noticed that in September of 2014, the top or the riskiest energy companies globally are not in the list that we had at the beginning of this year. It's completely different. So the credit environment is totally changed. It is, of course, affecting upstream a lot. And therefore, we need to start thinking differently about restructuring and thinking about what the recovery rates are going to be like, what the defaults are going to be like, and when we start doing the business. And if anybody wants to talk to me about Scotland, post-independence, and price drops as well, they can come afterwards and talk about that, but unfortunately, it's not too favorable. I worked in the Middle East for a while as well, and lived there. I was working with the Kuwait Investment Authority, and of course, they're all to do with prices. Now, if you look at them, when the price drops, there are 160 billion plus sovereign wealth funds have to think about where they're going to reinvest. So it has knock-on effects in the rest of the market. And what I want to just quickly, 2 more points, is S&P ratings. Their forecasts have completely changed. They are not forecasting above 80% per barrel for crude oil and 75 for WTI, so Brent crude against WTI. They're not forecasting beyond 2017 that they're going to go above these spot prices. So it's going to be an environment that continues going forward, according to S&P ratings in 2007 and beyond. And to kind of bring in this panel, the M&A activity, again, there's a lot of flip sides to what's going on in the market, because it's a record year for M&A, global energy M&A in 2014. $424 billion last year for energy M&A. And if you look at that, 80% of that is actually upstream, despite the fact that they're now being hit significantly with the price drop. And when you look at the valuations, it's 7 times EBITDA for upstream. It's not bad at all. But for downstream, it's nearly double that. It's 12 times EBITDA. So I think with that, there's many interesting points that I'm really interested to see how the practitioners start doing their restructuring in their valuations and deal makings. So I'm going to hand it over to Keith and the esteemed panel, and I thank you very much.
Big crowd this morning, which is nice to see, because things in the sector of distressed investing and advising have been a little lean the last 5 or 6 years. And I suspect that today's attendance is somewhat indicative of folks' expectations, maybe with a little dash of hope, is that maybe that's going to turn around. It's going to turn around largely on sort of some of the things we're seeing in the energy sector. We've got a great panel this morning. I'm going to right up front tell you, I am not the energy expert sitting up here. I'm one of you all that has a lot of questions that are going to affect how I approach some of the things with my firm and our opportunities over the next couple of years. So I'm taking the perspective of you all in terms of asking questions of the experts. On the far end is Bill Wallander. Bill is the head of Vincent & Elkins restructuring practice based out of Dallas. You will quickly, I think, appreciate, if you don't already, that V&E has one of, if not the strongest oil and gas practice in the Southwest and maybe in the U.S. Bill has written a definitive sort of treatise on restructurings in Chapter 11 for oil and gas companies and how the peculiarities of oil and gas operations sort of are affected or can be affected in the course of a Chapter 11 filing. Farley Dakin is my colleague from Mackinac Partners. Farley runs our Dallas office. He's been active in the oil and gas industry for a number of years, growing up in Midland, Texas, and is a very esteemed colleague of mine. And then J.P. Hansen is the co-head of the energy practice for Houlihan Lokey and runs the oil and gas side of that practice specifically, and is probably today, I would suspect, one of the most active folks in the country and on everybody's dance card in terms of opportunities in this space. So let's get going here. So as I said, JP, last 7 years have been pretty lean for most folks in the investment and advisory business, and it's obvious from this attendance that there's a lot of interest here. Very quickly, how did we get to energy being on everybody's radar?
Well, it's really twofold. Obviously, it's been a fertile ground for investment in the United States and, quite frankly, globally for many years, in large part spurred by the run-up in commodity prices. And now the focus has shifted more towards distressed opportunities as commodity prices have fallen. I think Pavel did a very good job of summarizing some of the supply-demand dynamics that we're experiencing in the U.S. If you bring it back to a global scale, the oil is a global commodity. And if you think about what's happened from a supply-demand imbalance perspective, globally we're producing 93, 94 million barrels per day. Demand had been somewhat keeping up with that, although supply was quickly outpacing demand. So we were going to ultimately end up where we are today. I think it's happened a lot quicker than a lot of industry investors expected, in large part because, well, Libya came back online. It wasn't known at what time Libya's production, which is 650 to 800,000 barrels per day, depending on the day and what's happening with infrastructure. But also the stagnation in the European economy slowed demand a lot faster than expected. And the declining growth trajectory in Asia, particularly China and Japan, has been a lot faster and a lot more voracious than expected, which means that while we're producing 93, 94 million barrels per day, demand is somewhere around 91, 92 million barrels per day. Doesn't seem like much. We're coming up short by about 1.5% in supply demand. But when you think about it in that 1.5 million barrels of excess supply can be stored indefinitely. From an end user's perspective, you don't care if it comes out of the ground or out of storage. We're at all-time highs in the US and quite frankly globally from a storage capacity utilization perspective, which puts pressure on that marginal barrel of oil produced in terms of price.
I think I've seen something recently that oil stockpiles in the U.S. are now at an 80-year high, something to that effect. So let's get to maybe the most important question in this room, right? Is this going to be a ripple for restructuring? Is it going to be a tsunami?
Well, I think we're in the very early stage. I think we're, call it the bottom of the first inning of this game. The companies that are currently going through restructuring were quite frankly at the cliff's edge before for a variety of reasons. They had taken on too much debt. They had used that debt to chase acreage that ended up not being as productive as forecast. The drop in commodity price was really just the swift wind that kind of pushed them over the edge. There is this next wave of companies, and that wave is increasing, if you want to call it a tsunami or a tidal wave. And that next wave, you'll have a mix of companies with subpar assets and those that have good assets with bad balance sheets. And the question is figuring out where best to invest and where to match up the capital allocation.
Sure. Now, Farley, you grew up nursing on oil in West Texas and have been very active in the space as an operator and an owner of wells. Tell me, you were at NAPE last week, and you've been in the circuit now for quite a while. What are you hearing from folks?
Well, I think to JP's point, I mean, I think it is early. I think there's, my sense at NAPE was, and NAPE, for those of you that don't know, is the international summit, in Houston, very well attended, mostly oriented to upstream. But I get the sense that, people are still putting on a smile and a facade that everything's going to be okay, hoping for that price bounce back that could rescue them all. But in the back of everybody's heads, if things go on beyond, 12 months, 6 months, 12 months, it just depends on who it is, but that there's going to be some real, trouble. I did also get the sense that, JP touched on this a little bit, but it seems like there's a lot of capital formation around what is the impending distress in the space. So, I think there's lots of people, waiting to see, and I think the attendance was, Bill knows better than I do, but the attendance was pretty high, just people there to see what was going on, checking it all out. So,
you'll notice that 2 members of our panel are wearing the Vincent and Elkins oil drilling tie that came out of NAPE. Nice fashion touch for this morning.
Intentionally coordinated.
So like most restructurings, liquidity is going to play a very big part in this, right? And liquidity driven by, what's going to happen with defaults, and the resets are coming up soon, as well as where folks currently sit with their derivative contracts and for how long their liquidity is protected. Farley, give me a sense of what management is sort of doing right now around those liquidity issues and what actions and steps they're taking.
Yeah, I think for most operators that are, maybe worried, it's all about accessibility and allocation of liquidity. Certainly there's been a few things in the press about, folks going out to the markets to get CapEx dollars structured very, very differently than they have been in the past. There's again, it's just trying to bridge themselves to that, proverbial, other side of, the bridge. So I think it's all around, those things right now for management, what to do with held, acreage that's not held, by production currently, and how do they, bridge that. What do you do with, work in process that is effectively uneconomic today? What do you do with that, and how do you deal with that as it relates to, the allocation of your capital? So, and then, obviously, dealing with your, your debt, your current debt and debt covenants. So I think it's all about that right now.
I mean, in my experience, when you have these sort of events, which are going to drive covenant issues and liquidity concerns, the first call from the company usually goes to their corporate lawyer, and the corporate lawyer, if they're doing the right thing, then walks down the hall to the restructuring or the bankruptcy lawyer. So, Bill, I assume you're in active discussions with a number of folks, sort of already, and are advising your clients. Tell me, give me a sense of the advice you all are giving the folks, and how companies are planning on reacting to, in particular, the April reset and covenant issues that may be driven around that.
Well, we are seeing a lot of activity right now on a broad spectrum basis, I would say. People are in the assessment phase of what's really happening here. To understand what's going to come, I think you have to look at what's holding companies up right now. And what's holding companies up right now is access to their credit facilities, as well as the hedges that they hold, which supplement their revenue. So, when these companies look forward, they have to look at, there's a crossover point on their hedges where the hedges start to roll off. They're actively trying to cut costs and expenses right now, which is having a direct and immediate impact on the service sector as well. But all these companies, it's as much a math equation as anything else in terms of their hedges, in terms of what they can cut in their expenses. We've also got redeterminations that'll be coming in the April frame. This first redetermination, because they typically are done on a 12-month rolling average, is probably not the one that's really going to be hard-hitting. I think the next redetermination later in the year, as that average comes down, assuming that prices stay at or about where they are now, will have a much more significant impact on the liquidity of the companies. Another thing that I think people should be watching for is, as the companies look for non-bank type financing, watch the payables, watch what's happening with their vendors and things, because the vendors in the E&P space have the right to lien up property, which can really bollocks up an operation. What we're seeing right now, energy services have a tremendous amount of pressure on them. The energy services, they don't have the supplemental revenue from the hedges or anything like that. There's incredible day rate pressure on the drillers, on the haulers, on all the people that work out in the industry. So the energy services people right now, if they got over their skis on their credit, you're going to see some of those, and we're already hearing of and seeing some of the services people have challenges. The E&P companies, a lot of that's going to depend on where they're hedged. Some of the E&P companies went naked last fall on their hedges and just simply took them off the table. Some of them did the three-way hedges where they get just a part of the fall of the strip going down, and whether that's adequate, time will tell. So the E&P companies that have very high leverage as well as a shorter maturity hedge profile, you could see some of those companies getting into issues. We're saying there's a lot of money coming to the table, and I'm sure people here are thinking along the same lines. What's the best way to come into this capital structure? The management teams, as well as all the creditors, are of the view that if we can weather the storm, then things will turn around and everything will be fine. If we can catch the uptick, I think kind of looking back at the 08, 09 experience where we had a significant recovery in the price of oil. So there are, in a lot of the high yield documents, as you look at that, there's a lot of baskets. Some of them are subject to some caps. Some of those are unlimited in terms of how much new secured debt can come into the equation. And there may be some higher coupon type money that will be willing to come in on some form of a term basis to provide that runway and that lift to pay the banks their interest, which will be critical. Also to make sure that they don't miss coupons on the high yield. And that may effectively buy some runway for a number of these companies, albeit it's going to be at a higher coupon, and thus there will be some equity decline in terms of overall value of the enterprise. But if the E&P company is faced with, I can keep my equity and have to endure a higher coupon, That's not really a difficult trade versus I have to right now go through a restructuring process where I know the equity is going to shift into the hands of my existing creditors. We're also seeing a lot of increased focus and activity on attempts to see if there's any ability to raise equity. There's exchange offers that people are looking at trying to effectuate those types of transactions to see if they can swap their debt for new increased and or better priced debt, things like that.
And covenant light.
And covenant light, if there are any covenants now. I mean, the lending at the top of the energy cycle tends to become more pro-borrower, and we saw that in this cycle. So there's a lot happening now. Is it going to be just an immediate crash? I don't know. I do know one thing about this cycle that is different, I believe, than the 08, 09, and that is the amount of capital that got invested into the energy production space is massive. I don't know what the number is. I know the word starts with a T. I don't know how heavy in the T it is, but it's an incredible amount of capital that needs to get some yield back. And how that's going to play out, whether it's going to be that it's kind of smooth, but then it just starts shoving these companies away because you can't get enough coming in capital to balance it, or maybe that capital is such that they're going to require getting to market with your product. So we really, I mean, it might be that we have a ceiling on price that's, say it's 50, say it's 60. Those prices for the capital that's priced in right now, that's not adequate to get them their expected return. So there's going to be, I think there's going to be quite a bit of out of court work this time. And I think a good deal of that's going to succeed. I'm not sure what the slice is going to be that's going to have to go through the court process. And the court process for energy, it's actually not a bad place to be in the E&P if you have all of these players, and there's many in the E&P companies, and they all have divergent interests, and it never starts off with a low volume dialogue. But you know, if you do end up in the court process and you get the right people involved, you can typically price these things out, because there's so many issues that have to be put together to keep the operation and generate the value and get the new contracts to the creditors. But I don't know, I don't see this year as the active year for that.
Yeah, and I think that's what maybe one of the messages we're leaving with y'all is that there's certainly a ramp here. It seems like it's not as steep a ramp as, you know, the pundits in the press or the stuff that you might read around might suggest. But having said that, I think it's still fair to say that in the last 4 or 5 years, a fair amount of the underwriting of credit to the industry has been driven by the commercial banks. And the commercial banks, by and large, still sit at the top of the capital structure.
That's right.
In a lot of these companies. And the thing I'm kind of thinking my way through, and JP, if you will maybe chime in on this, is, you know, when we start hitting, the April resets, and then probably the July and October resets, and that average starts falling down, and people start, falling into covenant default, what's going to be the posture of those senior banks? Are they going to be patient, and are the capital requirements that the Fed and others have put on them institutionally going to allow them to be patient to kind of manage through a recovery, or are they going to be forced to do things more actively and more aggressively and maybe less commercial?
So the old axiom,
and
right?
I will add just one comment. We tried desperately to get a bank to appear on the panel with us today. Nobody wants to talk about this. So just word out there.
There's the old axiom that you owe the bank $100 million, it's the bank's problem. Anything less, it's your problem. There's a threshold out there, and nobody really knows where that threshold is, at which banks' tendency might be to be a little bit more lenient. And when you say a little bit more lenient, what I mean is either step down the price deck that they use in the borrowing base calculation, step that down over time, or maybe they step it down right away, but allow banks or allow borrowers to repay over 18, 24 months. Or what some banks are talking about is, I'm the RBL guy. There's been one RBL that went bust in the 1950s. I'm not going to be the second one. So I have to squeeze down the borrowing base. but here's my term loan guy. And my term loan guy can come in and slot and fill that liquidity gap and basically term out the portion of the revolver that's already allowed for in the junior parts of the capital structure, but where I can't give you the capital going forward. And ultimately, as Bill was alluding to, this is all about extending the liquidity runway. And it's not even extended indefinitely. It's extended a little bit longer than the guy down the road, because the guy down the road's production is going to come off, at least this is the mentality, the guy down the road's production is going to come off before mine does. That means my production will be more valuable, prices will increase, and everything will work out fine for me. And that's the pitch that borrowers are making to banks to try to get that leniency. The difficulty is, as you mentioned, there's a much more stringent regulatory environment from the banking side than we've experienced before, which means that regulators may not let banks get away with or be as lenient as they otherwise would like to, which provides a bunch of opportunities, and that's why all this capital has been circling this industry. On the distress side is it provides an opening for alternative lenders to step in and provide capital when regulated banks, commercial banks, are no longer able to.
I mean, all the major houses in the last 2 or 3 months have announced plans for energy-specific funds. Several of them have launched. Apollo's fund is launched. I think Blackstone has launched their fund. And in addition to that, you've got these really well-heeled family offices that are very knowledgeable in investing in the space, and they're putting capital kind of on the shore. So Farley, the last cycle of this, actually the last 3 or 4 cycles we've seen through this, there's always been, where the liquidity starts driving pressure on the companies, some of the bad actors start coming out of the woodwork. So talk a little bit about, where that bad acting kind of manifests itself. And then, Bill, I know you've been part of these horror stories as well. You might want to chime in with Farley as well. So from a creditor perspective, and that's your nightmare. You got a liquidity and a borrower you can't trust.
Yeah, I mean, the last major downturn happened, that happened in Texas. I was very young, but I mean, it was my parents, and their friends, and and lots of people in West Texas were.
That was a jab at the rest of us on the panel.
Which took down all the SNLs in Texas. I mean, that was, really the last time that it was this dramatic and affected. Now, look, there's the interesting thing about upstream and E&P guys is they sit at the crossroads of, like I said, allocation of capital to drilling prospects, farm outs, distributing cash to their working interest partners, and however those things come together. So I think that I'm not presuming that this is going to happen this time, but it probably will with some folks. But the last time there was lots of money going different places that it shouldn't have gone in order to try to just live to fight another day.
Sure.
So I think there'll be some of that. I don't think it'll be prevalent in the publicly traded entities.
Where you have all the other disciplines but
there's
still.
There's just too many ways to get caught. But
Bill, thoughts?
Well, a lot of things happen on the way to grandma's house is the way I always look at this. You're talking about people that are very aggressive in business, and when their enterprise starts to have challenges, there's always a number of things happen that create gaps in understanding, gaps in communication. I tend to put all of that in a box. In my world anyway, if it's through the Chapter 11 process, we set up a trust at the end of the case which handles certain assets and certain claims. If there are those claims can be resolved that way independently by whoever the trustee that gets assigned to take it over. Unless it's outright fraud, and if it's outright fraud, you have different issues, and that manifests very early and is dealt with. But when it comes to the economic mistakes or people having different opinions over how someone should be paid, things like that, I tend to try to keep that out of the pricing mechanism early in the case. See if you can price the case, process the property, process the company, get the company in stronger hands if it needs to be. If it's in strong hands and the investors want to come in and leave that management team, and that's fine. But those types of issues, typically come at the back end. That being said, In the E&P space in particular, there's a lot that goes on, and there's a lot of money that moves around on the various wells with a lot of different parties. You've got your working interest owners, your royalty owners, this and that and the other.
Very complicated legal structures.
There is, and when a company becomes desperate for liquidity, they internally start trading their ponies for what do I have to have money for to stay alive. And you know, there's a certain optionality with certain creditors and what happens with the money, and there's a lot of things that get said. But companies in distress have to take certain steps to protect the entire enterprise with a more holistic view of what they're doing, and oftentimes that results in people not getting paid and this and that and the other. And a lot of times they'll come in and they'll say things that I candidly think are more aggressive as to what happened. I mean, there's business judgments made that, you know, I make a business judgment not to pay you. I can make that business judgment, and when you come back and say that was outright fraud, that you didn't pay me, you know, a company that has to meet a payroll as opposed to timely paying a vendor, they make those decisions all the time, and they have to make those decisions to keep the enterprise going. So we've actually been fortunate that we haven't seen a lot of the you know, fraudsters,
Sure.
at least not in the midst, but you know,
But they're coming. They are going to come because
Well,
you know, this is going to drive some bad behavior. So
you financial guys get under the hood, and you pretty quickly, you know, either come with one of those or one of those on what's going on, and that's very helpful because then we know better early on what's going on.
now I still have a number of questions, but this is a pretty, you know, highbrow audience, and I hope there's a couple of really good questions out in the audience that maybe we haven't thought of. It's a great panel with a lot of deep experience and expertise here. I'm going to look out here and see if there's a question or two, and if not, I can continue a little bit. Yes, sir, please.
What, somebody, the unsure there mentioned the last financial crisis in oil in Texas. What, at that time, we didn't have sophisticated distressed debt traders that we have now. Anybody on the panel, what do you see the impact of that change in the distressed environment?
Wow. JP?
Well, I think it's twofold. I think what we're experiencing right now in the oil and gas industry is more akin to 1986 than it is 2008, 2009 was really driven by the blow up of Lehman, which was a huge commodities trader and derivatives house, and the industry price reeled from not having that stabilizing financial factor in play. 86 was really the last time that we saw this major supply-demand imbalance. The difference is that there's a rapidity with respect to production because of shale production, because of increased technology at the wellhead level, the ability to choke back on production, that could actually help swing that production. Very much like that on the production side with respect to the industry, we're experiencing on the financial side when you talk about distressed players. There's now a voraciousness and a rapidity to which capital can get deployed. And as Keith mentioned, there has been a wave of funds that are looking to raise dedicated capital into the oil and gas space. Some of that is coming from investors who have a long history in oil and gas, but they're setting up funds specifically for this particular point in time, this environment, so that they can deploy that capital as quickly as possible. There's a very large fund that has a long history of investing in E&P, 20 plus years. And the Saturday after OPEC's decision to not curtail production, they called all the partners together and reallocated $1 billion from their general fund to a new E&P fund with the mandate to deploy that within 3 weeks. You don't see that elsewhere in the industry, in restructuring broadly or across a broad swath of industries like you're seeing it in oil and gas right now.
Bunker Hunt once testified in front of Congress when asked what his net worth was, and you know, the senators were having a tough time kind of pulling it out of him. And he said, you know, Senator, $1 billion ain't what it used to be. So, any other questions? Yeah, Ewan, please.
Is anyone brave enough to predict how many Chapter 11 filings there will be, energy related, in this calendar year?
I don't.
Yeah, Bill or JP, either one.
I'll take a stab at it. Bill, you can chime in. I don't think there will be as many Chapter 11 filings as you would expect in 2015. For the reasons that Bill mentioned, there are hedges and while there are a number of high-profile companies that decided to monetize their hedges in the fall, that's a very few. The majority of E&P upstream producers are significantly, if not majority, hedged. They'll live off of those hedges. They don't, I mean, ultimately for the long term it matters, but in the short term it doesn't matter whether you're getting $90 from the physical delivery or $90 because you're selling at 50 and being made whole on the hedge for the rest. So you'll see companies pull a bunch of levers, and E&P companies do have levers to pull. They'll go to the service providers and squeeze down on them, as Bill mentioned. You're seeing CapEx curtailments in terms of deployment of capital so that companies can live off of their existing cash on the balance sheet. You'll see companies high grade their existing inventory and say, you know what, I operate across 4 basins. 2 of those basins, I have economies of scale. This is a commodity business. Economies of scale, cost at the wellhead really does matter, as well as the acreage in which you're invested. Really, really does matter. So companies will say, 2 of these, I've got great economies of scale. I'm comfortable with the assets. These other 2, they're good assets, but I just don't have the economies of scale. I'll sell them off. I'll generate liquidity that way. You'll see asset level M&A activity as a result of that, which will generate liquidity and stave off those bankruptcies. Once again, it all comes, and then you'll see a bunch of financings, everything from traditional term loan financing to developmental capital, wellhead level financing, working interest sales. You'll see a reemergence of overriding royalty interest, sales and production, VPP type financings. You're also seeing, as Bill mentioned, a discussion around maybe some convertible or equity-like instruments to try to capture that upside as commodities rebound. Everything to extend that runway, which means that we probably won't see as many Chapter 11s in 2015 as you otherwise would expect. But if we're in this price environment in 2016 and beyond, that's when the real tidal wave will come.
Because I think if you take Pablo's sort of suggestion of, you know, $60 to $70 over, you know, as a ceiling over the, you know, next 3 to 4 years, I don't know what the percentage is, but there's a significant amount of production in this country that at $60 barrel is not economic. That doesn't cash flow.
Well, what I think will drive cases will be, in part, you'll have, if there's a liquidity crisis, that's always a problem. But some of these companies, you know, may get to a point where they have a large component of what I call stranded debt, and that is debt that they cannot deal with by negotiation or refi. It might be a contract that they're so upside down on that the damages claims are just going to be tremendous, things like that. And if you couple that then with the realization that the ownership of the company has to change hands, then in that model, depending on what the background is for the debt structure, Chapter 11 can be a very effective tool to get that changing of the hands on a very clean basis. In the article that we sent to everybody, we call it a synthetic plan sale. It's really not a direct sale of assets, because a direct sale of assets in the E&P space can trigger a lot of consent rights, pref rights, right of first refusal, both on the joint operating agreement and also in the lease level itself. So what we've come to do is to go ahead and push everything out into the trust that the buyer doesn't want, leave the remainder assets in the estate, reissue securities through a private exemption, and then everything revests on a free and clear basis in the new entity. So you clean up the new entity, get the effect of a free and clear sale of the direct assets, and that's one of the reasons I think where Chapter 11 in the E&P space can be a useful tool, because it can deal with other issues that come up when you're buying assets from a distressed entity out of court and a number of other things. There are risks with those transactions, and there are some buyers who will just ask the hard question, you know, what's my risk here? Well, if the risk is the value of the property, or you have to give the property back on some type of a recovery action, there are some buyers will say, I don't care if that's a 1% risk. If that risk hits me, I'm done. So tell me something that makes more sense than that. And the only way you can, you know, completely eliminate that type of a risk is to effectuate a transaction through some type of an 11 process, which some people are fine doing that process in a stalking horse capacity or a lead capacity, as long as they get their breakup compensation. They don't mind the risk of the transparency and being shown to the market. Other people prefer to do things on a more private basis, so it's all in you know, the eyes of the buyer. But you know, that's something I think next year, which probably drives these deals. There's going to be some slip and fall accidents this year. We don't know where they are. There are some things going on that will turn out to be problematic for companies, way over their skis on the debt. They just, you know, they have operational issues. They might have a regulatory snafu. I mean, there's a lot that can go wrong that I think will happen this year, but I think the driving wave is planned Q3, 4, and then 16.
So I think our time is up. I want to thank these gentlemen because over the last couple of 3 weeks that we've been sort of putting our heads together, this has been very enlightening for me, and they truly are sort of the subject matter experts. I had one last question that we're not going to get to, and I was going to ask Wallander to weigh in on the venue question and how much money the Texas economy has lost to Delaware over the last 15 years, which he's just chomping at the bit to get into that venue discussion, but we'll have to hold that discussion for another day. Thank you, folks. Much appreciated.